You ready to go?
Always.
Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
All right. Hey, how's it going, everyone? Episode 39. Ben and I were just saying we can't believe we've get this far. An episode, just a Ben and Chris episode this week. We had a big announcement today on Twitter and on our website and on Instagram. We'll post to the other social media later, but we are now building Bitcoin nodes for people. We're really excited. You can reference our episode 33, running your own node or running your own Bitcoin node. I forget the name of the episode to be precise, but I remember it was episode 33. So you can learn about all the benefits there, why it's important, why you should do it. And we kind of saw, a gap in the markets of people being like, don't get me wrong, it is complex to do. And while I recommend it's a good exercise or something that you should strive to do to build your own node, we think it's important to onboard as many people as possible to running their own node. So if you don't want to build it yourself, Ben and I will take on that task. We'll build it for you. We break down and, in the ethos of Bitcoin, we're open and transparent about how much it costs, what it is. Right now, we just kind of have one price. It's kind of the best node that you can run. We're going to look to try and source to do also a cheaper option. We'll add that probably in a couple weeks. If you want, you probably won't have as much capability with that node, and you might be hindered as things get better and the programs get better. But yeah, it's an option that we have right now on our website. We're excited. Anything you want to add to that, Ben?
Yeah, and I think it's not just we're only going to build them for you or we're not. It's if you have questions, you can always reach out to us. But like Chris said, the most important thing is that we get folks onboarded into the Bitcoin network as soon as possible. I think maybe I'll be our first customer. So I'm excited about that to start participating on the network and verifying the transactions. Without the nodes, there's no decentralization or trustless network. So the nodes make it happen. So
Yeah. And being a terrible salesman like I am, and I'm an engineer, I'm planning that when we do Ben's build, we'll record the whole thing. We'll show you how to build it yourself. And if you want to go around us and buy the parts and build it, honestly, I will take no offense to it. I'll actually be proud of you for doing that. So save yourself a little bit of money, learn how to build it yourself and learn how to run it. Like I said, I'm a horrible salesperson. I'm an engineer at heart and like people learn about their own equipment and technology. So
just an option.
Yeah, definitely. While this is not a Bitcoin episode, we just had to bring that up. So this is about target date retirement funds. So Ben, if you want to get right into it and tell me what is a target date retirement fund, how would someone use it, and how do they go about finding out more about it?
Yeah. So a target date fund, honestly, I'm going to use the word in the definition, but really the target date funds are either a mutual fund or an exchange traded fund, ETF. I know we've had episodes kind of clarifying the difference between the two, but what they are designed to do, they are structured to optimize your risk profile and to allow you to achieve basically a target asset allocation by the end of your retirement. Once you reach retirement, they're quite literally supposed to be a one-stop shop for your target date of retirement. And this fund is really a class of fund that periodically rebalances. I think what I was reading was most fund managers like to rebalance about every year, whether it's a fiscal year or calendar year, but annually is pretty common. And what those fund managers are doing, depending on their level of passivity or activity in the respective fund, they're reallocating the assets to adjust the risk and the returns for the specified time frame. And what's nice about these target date funds is that they're gradually supposed to shift towards a more conservative profile to minimize the risk as you're getting closer to retirement. The last thing you want to do when you're getting close to retirement is have sort of a COVID correction and you lose on paper 40% of the net value of your nest egg. The goal is to go from growth to wealth preservation.
Yeah, and actually, I'm glad you actually brought up the COVID correction. I was watching, I nerd out and watch videos till like midnight or 1 a.m. about finance and stuff. There was a lot of people that were hurt in terms of the COVID correction. A lot of the more senior people that are of retirement age, that they kind of knew from the dot-com bubble, it took about 10 years in order to recover to the highs of where they were. For example, like Amazon went up to 135 and then fell all the way down to $6. And then it didn't return to that, $135 stock price until about 10 or 12 years later. I forget Amazon specifically. So a lot of the more senior, how do I describe this? A lot of the more senior people or retirees decided to sell at the bottom in March or April and then not buy back in. And then all of a sudden, we started turning on the money printers. We basically started buying bonds at record rates. And we blow past the old high of, January or February of 2020. And we're now hitting all-time highs every day, every week. And so they kind of really missed out, and they had to basically then sitting with all this cash as the market recorrected back, and then they're buying in at those all-time highs at a loss. So they basically, and then on top of inflation and, they lost purchasing power. So I understand like the fear and, us being, humans and creatures of habit. They kind of looked at a historical trend. They're like, it's going to take 10 years to return. If I'm 75 or 80, like I don't have 10 years to recover back. So they thought they were doing something good, and then it ended up hurting them in the long run. And like I said, no one can be a predictor of markets. They could have been right, and the market could have kept tanking and could have gotten even worse. So I don't blame them, but just be very cautious about, be very cautious about how you invest and how you basically take on that, basically. So anything you want to add, Ben?
No, I think that's a good point, and that's kind of want to go into the next topic. Was basically, what is, I guess, the purpose of target date funds? I think there's a lot of misunderstanding, including myself, in terms of just like how I first started getting introduced to target date funds. I think there's sort of a misnomer of what the target date fund purpose is, and I think a lot of people misutilize the tool. We'll go into like sort of what the types of target date funds are. Maybe we'll start with that. Chris, do you agree with that, or we can start with how they work?
Let's start with the two types, then we'll go into how they work more.
Okay, very good. So the two types, there's a bunch of different types, but the two primary utility vehicles are through funds and to funds. So through funds are not as common as the to funds, which are really just a very standard, two funds being the very standard target date retirement funds. But we'll start with through funds. These funds continue to automatically reallocate the fund's holdings through a different group of assets and mix of assets, even after the owner of the fund retires. So through meaning it is continuing to be an active fund. Active being a broad statement, it is still reallocating, not necessarily the active trading strategy, but these funds tend to have a bit more of a risky profile, just knowing that the time horizon is much longer. It's not sort of a hard stop at that target retirement date. And I'll share my screen just to show, what is the title or ticker of a target date retirement fund even look like? How do they invest? But really what these funds, the through funds, do, they give you the potential for higher returns, but greater potential for losses at the start of the investment, or at least the launch of the fund. What's nice about these portfolios, though, is that they contain assets that grow way beyond just the target date, even through retirement. And the major differentiator between these and to funds, which I'll go into, is that they're meant to be held past their target dates. Now, this is where I think people start to get a little jumbled up about how to implement a target date fund strategy. And I'll start with just defining and explaining sort of what a to fund is. This is just, again, a regular target date fund, pretty much what you're going to see in your 401k for the most part. You'll have to fact check me. Always trust, but verify. Or as Chris and I like to say is don't trust, verify. So the major difference between the through and the to is that the to totally ceases reallocating investments at the date of retirement. Just it's no longer like an active fund. The fund itself has retired. And these two funds will absolutely work best if they are cashed out or or reinvested at the date of retirement. And the thing that I think a lot of people get wrong in terms of how they implement a target date fund is that they start by investing in other funds. So the purpose of the target date retirement fund, for better or for worse, is this is the only thing you invest in. In the purpose of sort of like an equity slash bond retirement portfolio. Investing in, another target date retirement fund or another set of funds or mutual funds or even stocks defeats the purpose of the target date fund, because those are specifically researched and designed and managed to automatically adjust your exposure to both equities and to bonds over time. By investing in, a certificate of deposit or CD or a different equity, you are either diluting or overweighting yourself into equities or bonds one way or the other. So thinking that you are risk adjusted, you've really just misadjusted your risk by investing in something else. So if you're going to invest in a target retirement fund, that's what really you should do. And just that, talking specifically about the IRA or 401k. So a lot of folks invest in multiple, but what you're doing is you're just kind of getting exposure to a higher expense ratio fund, and you're skewing your risk profile and the purpose of those funds. So that's one thing I definitely wanted to bring up there.
Yeah, so I guess what does rebalancing look like for any given fund or for one of these? So I know you've kind of said the through and to, but I guess aside from rebalancing on a yearly basis, what would it look like in terms of the assets in it?
Yeah, they're pretty similar in terms of like a through versus to. It's just sort of like the time horizon and sort of like risk exposure on both, but they start in a similar place. So when the fund launches, the risk tolerance is fairly high. Like when you go into, let's say we're going to talk about the target date 2060 fund for Fidelity or something, you're going to be, we've got almost 40 years, 39 years to go. So the investors of that fund are expecting growth, and they're at least expecting at market returns being sort of the S&P 500. So those fund managers are sort of, it's prudent for them to have exposure to like higher growth, but also speculative or volatile assets, which tend to be, equities, tech companies, maybe things with higher PE ratios, much less exposure on the fixed income, but a lot of these funds still maintain exposure to fixed income regardless. They tend to have some level of bonds or some sort of other cash yielding asset, which might be a dividend stock or real estate. And the rebalancing process, again, is very, very similar for both, depending on sort of the fund and the fund manager themselves, but the risk tolerance decreases over time. And what that means is that you will start to see that the overall portfolio allocation over time will change. And a lot of times these funds will have marketing materials called that explain the glide path of the investment. And it's sort of like a taper where you'll see the graph sort of at the top of the y-axis being like percent allocation to US equities. And then maybe down below, there could be another graph superimposed to that with bond exposure. If you have a graph, Chris, that'd be amazing.
Yep. Do you
look
see
at
it right
that?
now?
That's awesome. Yes.
Yeah.
This is it. Go ahead, Chris.
No, go ahead. Keep going.
No, you're on a roll. Make it happen.
Yeah. So as you can see, like it's, the legend here says U.S. stocks are in the red, international stocks are yellow. I apologize to anyone that is colorblind, that has colorblind issues, but yeah. So or anyone listening to the podcast instead of on YouTube, but the navy blue is U.S. nominal investment grade bond. The teal is treasury inflation protected securities, and then in the end, you'll have a little bit of cash to hedge against the volatility. So basically, as you can see, when you're young, you're like 90% in stocks, with 20% internationally, 60% 70% US, 20% international, and then US nominal investment grade bond. And then, you're kind of transitioning to later in career. They kind of taper you down in terms of international and US stocks, and they ramp up your bond allocation and eventually give you a little bit of cash allocation as well.
Yeah, so we'll talk about sort of like the dynamics and the benefits and what have you, but it's really sort of a nice strategy if you want to go fully autopilot in terms of your retirement investing. And what's really nice about these target date funds is like they don't really care what you're doing at the end of the day. So like what is becoming more prevalent, and again, do your own research about whether this makes sense for you. And there's obviously alternatives in terms of robo investing or just picking a S&P 500 index fund or otherwise looking into these target date funds and see what makes sense for you. But if you have like a sort of near or midterm goal, in terms of, buying a car, a house purchase, funding a kid's college tuition, there's obviously vehicles to do that specifically, but these are nice ways to have sort of a goal-based investing, because if you have a plan for when you want to purchase that thing, these are a nice way to do so, where it's like, okay, I want to buy a house by 2030. You could invest in stocks and have a higher chance for growth. But if you use a target date fund, you know that you're getting very, very close to cash or cash equivalents by the end of that term. So at 2030, when you're ready to buy that house, you want the equity and sort of like the portfolio value to be what it's going to be when it's time to cash out. And that's the purpose of the two funds, is to either cash them out and reinvest them. They basically become cash. They're sort of cash alternatives at the date of retirement is the goal. So that's a nice alternative. But yeah, it's really just designed to be autopilot in terms of risk adjusting and getting you closer to fixing the value of your portfolio. Whereas on the other flip side, the through funds are meant to continue to grow through retirement.
Yeah. I guess we'll move on to the next question then. So Ben, like, what are the pros and cons of target date retirement funds overall? Your take on it?
Yeah. So I would love to obviously have a back and forth after we sort of get through the Q&A portion of this, but I'll definitely start with the pros, because there are a lot of benefits to target date retirement funds. And what is really nice is that at least what I've seen, most retirement providers for like the employer sponsored plans, like the 401k or 403b, is that what it is?
Right,
for like,
right.
Okay. They typically default you into a target date fund, and it's usually selected based on your age group. So what's really nice is, like, even if you don't know anything about how to even pick the funds in your 401k or otherwise employer sponsored plan, you're going to be invested probably in a target date fund. And I think that's a really nice sort of default, is that you know that your assets are going to grow at sort of like a marketed rate. They're really not looking to impress anyone. The impressive side is just consistent returns, not guaranteed, but it's a very, very conservative portfolio and way to invest your sort of nest egg. And again, it's meant to be an autopilot structure. And like I said, these funds are becoming even more fluid in terms of their utility, working towards future expenses such as like college tuition, home purchases, car purchases, what have you. These target date allow you to have sort of these like time-based goal investment strategies. And again, this diversified portfolio, which is sort of like a built-in solution for your retirement portfolio, there's no need to invest in something else. In fact, investing in another sort of asset class or fund type really just skews your risk profile. And I would strongly suggest you just look away from the target date fund if you're not looking to invest in one of the ways that we sort of mentioned here, being a goal sort of based investing where it's not in the retirement side, or strictly retirement. You just invest all in on that fund. So downsides. And Chris, let me know if did you want to talk about another benefit that you're thinking of for the retirement fund that you thought of?
No, you'll do the cons and then we'll kind of open up discussion here.
So sort of the downsides, and this is not all encompassing. There's definitely more philosophical and technical discussions to be had on these funds. But one, they tend to have higher expenses than other passive indices and funds. The reason being is that inherently to these target date retirement funds is there's work to be done. It is not simply, invest, track a market or benchmark and just perform as the benchmark, which is basically just picking the top big ones in that respective benchmark and just let it ride. With this specifically, you really have to be hopefully mindful of market conditions. And it's a fairly, even if it's a passive strategy, it's an active strategy, because you're rebalancing every single year in sort of like this temporal adjustment to get to a target asset allocation. And that is difficult. If anyone listening to the show is doing their own sort of like money management or investing themselves, trying to get to a target allocation, especially in an asset class, and doing it successfully year over year, is difficult because the market conditions might not be favorable for you to sell some stocks. You might be selling at a loss just to get some arbitrary asset allocation. And I think that's the downside already is you are getting to this arbitrary asset allocation of risk versus reward, where it's like that 60-40 stocks versus bonds. But, if you've listened to our show and we've discussed this, this is the absolute worst time to be buying bonds. We just saw the CPI is about 5.9%, and bonds are trading you're getting a 1.3% yield. I haven't looked at the 10-year in a little bit.
I checked yesterday. It was like 1.22.
Oh, awesome. Even worse. So you're seeing a negative real return of like what, 4.4, 4.5%, just by holding bonds. So instantaneously you're losing money by investing in those bonds, and they're meant to be conservative, but they're conservatively losing you money. And that's the difficulty of being in sort of these target adjust and self-adjusting funds, is they make it too conservative too quickly. And depending on the market conditions, it might be unfavorable to have that exposure to fixed income or even equities. It just depends. Again, the income is not guaranteed. Like, market conditions are subject to change, but that's the same with anything. It's not to be expected that you're just going to make money immediately, but that's kind of what they're trying to advertise. Another thing with the target date retirement fund is there's a little room to really adjust goals. You have, and I'm going to share my screen in a moment, but you have these target date funds for 2060. You may come into, you sell a business that you own, or you sell some equities that you've been investing aside, and you can retire a little bit early. The fund doesn't really, again, like I said, it doesn't really care, and it doesn't really have that IQ ability to adjust. It's going to continue to perform as if everyone's retiring in the exact same way at the exact same date, and then you sell and or reinvest.
Or you could sell a property, have a loved one give you an inheritance. Like, there's a whole bunch of ways you can come into money later on in life that you probably weren't expecting. And, we hope that happens to everyone, barring not losing a loved one, but, getting money from a relative or something like that at no chargeback. Like, you could retire early. So, yeah, and kind of like what Ben was saying, it doesn't really care. It just kind of does its own thing.
Exactly. And on the flip side, you might have to retire later. I mean, that happens probably more often than not, honestly. Things happen, and inflation is a beast to try and keep up with, and expecting and being able to predict, in 2021 that, Ben is going to retire by 2060. I hope so. I hope I do it earlier, but it is very, very hard to forecast that. So on the flip side, you're sort of stuck holding the bag on this, like, target date fund that's going to cease sort of like the rebalancing strategy that you signed up for. And maybe you have 7 more years before you're ready to do that. Maybe it's 2067 that I retire, which would be unfortunate, but it is what it is. So it's just something to be mindful of, is just making sure you keep track of like where you're at, project out. A lot of your 401k providers would have sort of like a projection, but it's just one of the downsides to be mindful of. I think the last con I want to talk about, and I know I'm rambling a little bit, but the main thing to note, I think, especially when you're picking one, if you're just starting a new job, switching jobs, is not all funds are created equal. And Chris, are you seeing a split screen of 3 panels?
Yes, I do. It looks good.
Cool. So for folks that are just listening to the show on Spotify or any of our other providers, I'm basically sharing my screen for 3 2060 target date retirement funds. And the first being, I'll go in order from left to right. It's Vanguard, BlackRock, and Fidelity Freedom. So they are both, or all 3 of them are target date 2060 funds that probably are in someone's portfolio on this call. I think I can pick the Vanguard one actually in my new job, which is really funny. So I'm looking at this, and they both have the same target date goal, but very quickly, just looking at the line items. So just for folks listening, I have Morningstar up, and it has a breakdown of the portfolio in terms of the asset class allocation. So going top to bottom, you have U.S. equity, non-U.S. equity, fixed income, other, cash, and then not classified. Don't know what not classified could be. It could be anything from like municipal bonds, maybe, to real estate.
Maybe a REIT, like a small.
Yeah, I was thinking real estate. It could be real estate.
Because it's higher and then it goes much, much lower. So I'm assuming it would probably be like a REIT or real estate or something, like a riskier quote unquote thing.
I think so too. So looking across the board, the Vanguard to BlackRock, pretty similar on the U.S. equity side. You got 54 to 56, but you go right across from BlackRock to Fidelity, and US equity is 43%. So you have a 13% difference in terms of the US equity exposure. And then going down to non-US equity, they're pretty much in line. It goes 36, 41, 44. Still a pretty big spread, but I think really the biggest spread in terms of just like risk adjusted exposure really popped out at me at the cash side and also fixed income, where you have Vanguard almost at 10%, it's 9.5, whereas BlackRock's almost at 0, closer to 1. And then you have fixed income at 6.5 for Fidelity. So we're not retiring for another 39 years, and Vanguard already has you at 10% bonds. And maybe that's fine, but they're different. And again, on the cash side, it goes almost 0 for Vanguard, 1% for BlackRock, and then 5 for Fidelity. So I like, there's not really one key takeaway here. The key takeaway really is go into your funds. Don't just look at the returns and move on. Look at what they're doing, because these are more muddy than the sort of like equity funds, where it'll be like US large cap stock, growth stock. You can pretty much expect it's going to be Facebook, Google. It's going to be all the tech and the FANG, blah, blah, blah. But you could, again, still look at that. But with these, allocation is so important. And you might not be comfortable with how they're investing. So I think my first recommendation among the others is get comfortable with how they're investing and see their strategy, their glide path. And then next, look at the expense ratio, because they tend to be expensive, because no matter what, someone has to be behind sort of the computer moving the needle on the allocation. So that's the key takeaway, is they're all different. And you need to just like understand sort of like what you're investing in, especially if you're in here for the long haul. If this is your one-stop shop, you better be comfortable with it. So that's my last con. Not necessarily a con. It's more of a red flag is what I would say. A yellow flag of warning.
Yeah, I think that's good. I mean, just looking at them from a high level, I think the BlackRock would probably be the best investment of the 3, just for my personally. Obviously, I can't predict what the market's going to do, but it just seems it gives you the most in equities up front. And even though it has 1% cash, which isn't great.
That's okay.
Yeah, it's not terrible, but it gives you the most basically equities or stock up front. And, it really is minimal on the fixed income till much later on in your career.
Yeah, I do want to flag that point about the cash. I was just thinking about this right now. And this obviously could be changing I don't even know. This is just an arbitrary snapshot as of June 30th. And it could be different today. It probably is. So I wouldn't be too worried about seeing the cash, because that could be timing for when investors are funding their 401ks. Like, you never know, like a company could have just onboarded into BlackRock and into this fund specifically. And also having cash on the side means that they also have flexibility. So having like a little bit of cash on the side just means that they have the ability to sort of move investor money around. Having 0 concerns me on the Vanguard side, because that means they're distinctly selling assets, which could trigger sort of like a taxable event for them. Not necessarily for the investor, but it could eat into your expense ratio. And
that's a great point. So nothing is ever free. And, you being the customer of these allocations or these portfolios, don't think Vanguard, BlackRock, or even Fidelity are picking up the tab. If they have to move things or change things, maybe the overall expense ratio remains the same, but there might be hidden fees that, they have to sell or buy or sell or do all these different things that, lowers your returns later on in life, that like are arbitrary fees that you didn't even realize until much later. Normally when you're sitting down with your advisor and they're like, oh, by the way, you were charged about $1 million over the course of 40 years, 45 years, 50 years that you didn't even realize.
Yeah, exactly. And to that point on the fees, I think this is a good segue. I didn't even think to do this, but you can already see the expense ratios are very, very different. And that may make your decision. Just because you have a target date fund in your portfolio to choose from, it doesn't necessarily mean you should just pick that one. Like you could always fund an IRA and pick a better target date fund if you're trying to invest that. And maybe you could still do it. But if you're not comfortable with it, never feel like you have to invest a certain way. we're giving guidance, but like you have to be comfortable in yourself, like where you're storing your nest egg for the long term. And maybe you put the full amount in that you would want to do in a target date retirement fund in your IRA. And maybe it's, you just do a target date fund that you like in your IRA, and that's what you deal with. But in your 401k, maybe you do something a little bit different. But looking at the difference between the Vanguard, BlackRock, and Fidelity, again, going left to right, you have an expense ratio of 0.15, 0.09, which is really what I would expect from the Vanguard, but it's higher on the Vanguard. And then Fidelity is 0.75, and that is beefy. I mean, that is like almost an order of magnitude higher than the BlackRock. So that's a red flag for me. When they're meant to simply just like get returns. And I'm going to see what the performance is because I am curious. But the fees are a big thing to be mindful of. And you can always, I think, Chris, do we make an expense ratio calculator comparing funds? Because if not, I'll do that.
Don't know if we did. I know we've talked about it in the past and showing like, I know we've definitely said 0.5, 0.75, 1, and 1.5, and how much money you lose over a 40-year, 50-year period of the expense ratios like that.
Yeah. So maybe that's something we can work on in the background. It's just like picking funds. Cause that's like something we would definitely advocate for is when you're not investing in Bitcoin. Like I really like the sort of passivity of index investing unless you want to, really get into the weeds of their companies. But looking at the total returns, and we kind of compare the major discrepancies between their fee structure. You've got Vanguard, which is 13.25. For the year,
year to date, 12.
Year to date. Sorry, lost it. So Vanguard year to date, I'm pointing, but you guys can't see that. Year to date is 12.11 for Vanguard. Year to date for the BlackRock is 13.9, and then year to date for Fidelity is 13.09. So the lowest fee fund is performing the best year to date. And I know it's a small time horizon, but it's something to be mindful of. And maybe we can go to this since inception. Yeah, we'll go to the since inception, or at least the 5-year, because all three of them have 5-year histories. And we'll go left to right: Vanguard, BlackRock, Fidelity. It's about 13.2, 13.4, and then 14.09.
So the Fidelity those are the 5-year. Yes,
those are the 5 years.
Since inception, it's 11.72, 15.2, and 11.04%.
Yeah, and that's just the way it's sort of trailing. So you have the cheapest from the since inception. So and that's really what you care about is when you're looking at your target date retirement, but you want to look at the since inception because that's what you have. It's as close to what you have as it'll get, just because like that has the longest sort of like reporting history. But to be mindful, like the fee doesn't necessarily mean return. You have the lowest expense ratio fund returning the highest returns out of these three. By about 4% on the since inception. And that's the BlackRock fund. So again, always be shopping when it comes to your funds. I think with your 401k, you're limited, but get comfortable with what you want to invest in, but never feel sort of like obliged to invest one way or the other. Just know that there are other options out there and there's other vehicles to get exposure to a respective fund.
Yeah, definitely. And I just looked this up. This is a study from 2018, but the average target date fund had an expense ratio of 0.15. So that's kind of high, 0.5%. But the fees can range anywhere from 0.1% to more than 1.5%. So there's definitely a bunch of room to shop around. Obviously, you're normally limited by your company's 401k or 403b, like what you can invest in. A lot of times there's only a few options, or, if it's Vanguard, BlackRock, or Fidelity, you can only pick their target date retirement funds. Normally there'll be other mutual funds and indexes in that 401k, but normally you're kind of hindered by that. But if you don't like what you see, you can always not invest in it or invest in something else. Open up a Roth IRA, which Ben and I have talked about before, and kind of pick your funds yourself.
Yeah, and something to be mindful of, and something you said sparked kind of like a thought, Chris. When you pick sort of like a company's target date fund, something to be mindful of is like the Vanguard, the Fidelities in those funds are going to be those respective funds. So like you're investing in a Fidelity target date retirement funds, but inside there are all Fidelity funds for the most part. Like I think that's what I've seen for the most part is they use their own funds. So something to be, I guess, weary of, or at least mindful of, is that you are kind of putting all of your eggs in one company's basket, not necessarily one stock's basket, but one fund manager, parent fund manager overall. And And you may be comfortable with that. I mean, most people can be comfortable with that, I think, just because they're so large. There's a lot of liquidity, and like the worst case scenario is they just like liquidate and give you your assets. I think you'd be fine, but it is something to be mindful of. And if you are trying to do something similar to the target date retirement fund, but you're not comfortable with that, you can almost simulate it for yourself, where you have exposure to US equities, non-US equities, fixed income, and you could always adjust yourself. I mean, that is something that you can do. Most of the time you have the ability to do so. It just takes a little bit more time, but the resources are there, and you could also look at the funds yourself and pick the best sort of like diversified set of funds that you're comfortable with. And if you want to be more active, you could do that. But yeah, there's just something to be mindful of there.
Definitely. Yeah, so I guess, do you want to open up the discussion now, I guess, or do you want to ask?
Yeah. I think that's pretty much all I wanted to talk about, was really just like introduce what is the purpose, some pros and cons, and maybe sort of how they're being misused at times. Because they're really a very, very different class of funds. They're not just giving you exposure to like a sliver of the market. It's meant to give you exposure to all of the market, and you only invest in that. And otherwise you're kind of diluting or overweighting otherwise. So that's really what I wanted to bring up. So Chris, I did want to ask, after this discussion, or really any research you've done, what are your thoughts on target date retirement funds? Do you use them? Just really anything. I'm curious to hear your thoughts.
Yeah, so historically, I've never used them. This is just kind of, I guess I used them at a couple of my companies, but it would be more exactly like you said, you're setting up your 401k in the very beginning. Money was going to it, and a little bit went into it in the beginning, but like less than overall, like 0.4% of my portfolio is in a target date fund. Like I said, it was normally just my first paycheck going in. It goes into that, and then you reallocate. And, based on what they could sell or trade or whatever, I just had very, very minimal amount. I wish it was at zero personally. So I guess there's a few things. I'll kind of expand on the cons. I know we kind of listed the pros and the cons. I think Ben's true that if you have no idea what you're doing, they're a good starting point, and then you can learn from there about how you want to allocate your money going further. I don't think that's a bad thing at all. But we've got like the greatest bond trader of all time in Ray Dalio, saying that he'd rather own Bitcoin than a bond. So I think it just goes to show that a guy that's been doing this for 50 years. And I think Ben and I think we did justice in describing how like people make money on bonds. As interest rates come down, let's just say you bought a bond, and we'll just use ridiculous example. Let's just say your bond it's a 10-year treasury note at 10%, and that's ridiculous. I can't even remember the last time, or if it's ever been that high. It definitely has in the 70s and 80s. But anyway, yeah. 10-year treasury note at 10%. And let's just say, as they pull interest rates down, now interest rates are the 10-year treasury. I just looked; it's 1.17, so it's fallen even worse than what I was saying, the 2.1 or the 1.22 yesterday. Anyway, so from 10% down to 1%. So let's just say you've had that bond for 5 years. You can now sell that bond because it's got 5 years remaining at that 10% interest rate. So that value of that bond after getting paid the coupon is worth that much more money. And there's an equation that you could figure out as the interest rate comes down, as it adjusts, what the value of that bond should be based on how much time is left. So let's say you had $100. If you're getting 10% at $100, that's worth a lot more than today at getting the same $100 at 1%. So someone will buy that bond and ride that bond to conclusion, basically. So, if you're getting $100, a 10% or 10% bond, so every year you're getting $10. Versus if you're now the new bonds, let's just say they're 1%, $100, you only get $1 per year over the course of its 10-year life expectancy of it. So there's obviously an equation to figure out how much that's worth, basically. But obviously you've got Ray Dalio saying bonds are a bad bet. And the reason he's saying that is that interest rates are at all times, like pretty much zero. And I know it's like, oh, what do you mean? Like, oh, the 30-year bond is probably at 2%, the 10 years at 1%. I think the 5 years probably like 0.7, 0.6. The 1 year is probably like 0.3, 0.2% of your money. But when they're saying these interest rates are at those amounts, I know we've talked about before, and I'm just rambling, but basically it's the amount of money that it takes banks or companies to lend out money. So right now, if you're BlackRock and they have, literally trillions of dollars under like assets under management, I think it's like 17 trillion, or I forget, 15, 11, if you want to look that up, Ben, real quick. Let's just say they have 15 trillion under assets under management, which is probably right. 9. Okay. I was a little high. So they have 9 trillion assets under management. Yes, that's quite literally 9 trillion assets under management with a T. The banks are lending them if BlackRock wants to buy anything, they can buy it at an interest rate of 0.03 or 0.04% interest. Where like right now, if you're trying to buy a house, interest rates are probably, last time I checked, around 3%, 2%. If BlackRock wanted to buy it, they're basically borrowing money, or they're saying like, if we default on this, you get a piece of our business and we have to pay you back based on all our assets. So they're a much more reliable lender, or a person that a bank would rather do business with than me. Even though I have good credit score, they have that much more collateral and power and purchasing power that bank is like, oh, BlackRock is a better investment than Chris Alaimo and Ben Gassaway. You just, on paper, who would you rather lend to? BlackRock, who has $9 trillion under assets, or me, who has a net worth of like $100,000 or whatever it may be. So it's basically, they're just looking at risk, and based on that risk profile, they're willing to give larger amounts of money at cheaper rates versus someone like me or anyone. That's just kind of the way that it works. I won't say if it's fair or not, but obviously the bigger companies get more money. So I'm kind of just rambling now, but basically I don't use target date retirement funds because bonds are just such a bad investment. And I think they put them in you way too early, put you into bonds way too early. And I think you have too much exposure to them even later on in life. I mean, right now we're seeing inflation, Jerome Powell and the federal chair or the Federal Reserve just announced that inflation was like 5.4 or 5.1 in their most recently quarterly talk. And if your bonds are only getting 1% or 2%, you're quite literally losing purchasing power. Yeah, you don't, if the market tanked 50%, you don't see that downside. But, we quite literally are well aware that you're losing purchasing power slowly and then quickly. That's kind of the, the saying of, the debt spiral that we're kind of in.
Yeah, no, well said. And that's similarly where I'm at. I actually, going back to sort of the amateur, I think we'll probably wrap up pretty soon, but going back to sort of the amateur investor, I think the most important thing is recognizing when you do something wrong. I have been investing in my target date retirement fund wrong. I've been using it as it's been small, but it's also been ineffective in terms of the grand scheme of things. So I've done probably a 5% allocation to my target date fund. When I roll over my 401k from my old company to my new, going to correct that, and I'm actually going to look at my asset allocation that I have in my little spreadsheet there to readjust that and distribute otherwise. But yeah, I mean, this was helpful for me to think through what is the purpose of target date funds. It's not really just a thing to diversify into. It's meant to be a thing to invest in solely, and otherwise you're really just kind of confusing your overall risk strategy. So I think they're very effective, but I am not uncomfortable managing my own portfolio. I already do it on sort of an individual equity basis, and it becomes even easier on sort of a select few funds. You can just kind of set it and forget it, and I've got a long time horizon, so I'm pretty comfortable where I'm at. But again, get comfortable with where you're at, and as always, you can always reach out to us with questions, and always happy to share what I do, what I have. I don't really care about that. I think money has always been one of those taboo things not to talk about, but I think it's something everyone equally need or equally wants, and some folks need it more than others, but I think the need is information around money, and that's, I think, where Chris and I want to come in. So always happy to reach out, but they're a good place to start.
Yeah, and I agree. I think there's a quote that I heard recently. I forget who even said it. It was the people that say that money doesn't matter are kind of doing a really big disingenuous thing for themselves, because you say it doesn't matter, but you go to a 9 to 5 or your job or however many hours you work, or even if you're a business owner or whatever, you say it doesn't matter, but you still need it to pay your bills, to, afford rent, to do all these different things. It's I know there's evil parts to money, and there's things that people don't want to invest in. And there's definitely there's a downside to anything. But it's important for protecting your purchasing power and, your generations. We want to help people build generational wealth. And, when you think about it, the money is definitely a part of getting that. And I just think it's really important, you use it every day for, gas, for Starbucks, for Dunkin' Donuts, for food at the grocery store, for your rent, for we literally use money for everything. So at the end of the day, you have to look at it, be it's not an evil thing. It's something, it's just a tool. And I want to use this tool to the best of my ability to, make it better for myself and my family and, future generations to come, basically.
Absolutely. I love it. Want to wrap this up?
Yeah, definitely. So thanks guys for listening. Once again, find us on all social media platforms: Twitter, Instagram, TikTok, Facebook, LinkedIn. our website. You can go to our website. I think what's it called? Building a node or building it. Let me look it up right now.
I think it's building your node is the SEO.
Building your node. So under there, you can we have a little bit of why build a node, about our services, the cost of how we build it, and you can place an order if you'd like. We'd really appreciate the support. If you have any questions about the node, target date retirement funds, anything finances, even something Ben and I don't know, we'll definitely put you in touch, or we'll figure it out for you what your question is. So anything else, Ben, you want to add?
No, we've got another announcement coming up pretty soon, so we're excited about that. But yeah, more to come. But thank you guys for listening, watching, and learning with us.
Thanks, guys. Have a good one. Talk to you later.
See you next week.